I'll give up my gold for interest bearing. You get paid back in dollars that are losing their values. Do you think it's coincidence that the head of credit for both BlackRock and Blackstone resigned last week?
Same time.
Same time. The COMEX market trades roughly 200 times what is available every day. How does that happen? What does that mean? That means that there's make-believe contracts that suggest a different price.
Silver pulled out from CME 600,000 ounces today.
Okay, that's my point. Could it be that there are cracks coming? And if you see a bond market implosion, it's far more dangerous than a stock market.
I was going to say, most people think that they're worried really more so about an equities crash. Solid state battery coming online next year, using a kilo of fine silver per, and thrifting not being a quality alternative. How could that have an impact on the spot price moving forward?
But the next time it goes higher, not only do I think there won't be the kind of selling that there was, and hopefully it doesn't happen the first week of January when the ETFs rebalance and allocations are coming out, I think it will be an awakening to a lot of people like, holy shit, I better get something.
Sweeney 55 wants to know, since China has halted the gold retail leverage contracts, is the plan to possibly let prices reveal true prices?
Over time, yes.
That's exactly
and
what
they're incentivizing their people to buy physical. The big banks are closing the ability to speculate that way. Their exchanges are same-day settlement, cash and carry. They're aligned with other exchanges that are doing the exact same thing. That's exactly what they're doing. But they do things very strategically. See, you guys all see things, are able to compartmentalize things and see out, and most people can't. And what they are doing is setting up the board, as I was saying, all of the vaults, the payment rails, the relationships, and the settlement now system, so they can settle, they can vault, they can pay over a network that will settle imbalances in gold through a series of multi-jurisdictional vaults and trade with one another in their own currency. That is the ultimate game, but it has to be done very slowly and quietly so as to not, rock the boat too much. So yeah, that is exactly right. And I think that is what is happening.
All right. Let's go to the next George Safis.
But slowly.
George Safis says, Andy, trying to figure out why gold fell in Q1 of 26, while at the same time, central banks bought approximately 240 tons.
Oh, there you go.
Supposedly more than any other quarter in history. Thoughts?
I think that the big money is joining in. And I wouldn't be surprised if you told me it was the U.S. government who did it, because who stood for delivery?
China is restricting leveraged gold speculation while quietly expanding settlement infrastructure. And that contradiction deserves more attention than daily price swings. Andy Schectman notes this shift reflects deeper structural preparation, not short-term market management. Physical ownership and payment rails often matter more than futures volatility when monetary systems evolve. Investors focused only on spot prices may overlook where strategic influence is accumulating. Next, Andy Schectman reveals why record central bank buying coincided with weaker prices, exposing a contradiction retail investors rarely question.
For how many ounces? It was 4.1 million ounces of gold. What is that? I mean, it's a huge amount. It was even more than that, I think. I don't remember the exact numbers in February. It's the largest delivery in February ever here in the United States. And 14 billion, it was 20 billion, I believe, in February, stood for delivery here. 14 billion last month. The point is, every month it's billions. What if the US government and some of the big proxy banks and even some of the Chinese, they say, let's play the same game. We'll short the paper price and stand for delivery at subsidized prices. We can just print more money. It's exactly what they're doing. Who would be stupid enough to do this? It's people who know where things are going to ultimately land. And it's not all that. But if I had to guess, there's a certain amount of central bank suppression, whether it be through the BIS, whether it be through hedge funds that are running proxy for central banks, or even the Exchange Stabilization Fund. Knock the price down, stand for delivery. And I think that's what they're doing. And don't you find it interesting that the central banks buy more than at any time in history? And by the way, they underreport it. The World Gold Council said your first quarter numbers were 15 times underreported by import-export numbers.
Fugazi.
So they're buying it. They're lying about buying it. And if they're lying about buying it, why not suppress the paper price to accumulate it?
Of course.
Realizing that the game is almost over.
Record physical delivery can increase even while headline prices remain subdued, creating a disconnect sophisticated investors monitor closely. According to Andy Schectman, institutional accumulation deserves more attention than day-to-day paper pricing. Large delivery requests alone do not prove coordinated suppression, but they can indicate unusually strong demand beneath the surface. Savers who ignore physical flows risk reacting only after broader market sentiment shifts. Next, Andy Schectman exposes why reported central bank purchases and visible market pricing appear to tell two very different stories.
So let's do it through proxy entities so we don't have our footprints in the snow and let them knock the price down while we quietly, through them, stand for delivery for the Exchange Stabilization Fund under the guise of national security, which would not require congressional approval. Could it be? I don't know. But to your point, it don't make sense without realizing something to the extent of the big players are saying, you know what? Screw it. Suppress the paper price. We'll just come up with more cash. I want the metal. It's worth more than all of it.
And that brings us to the next question. Coyote 1 says, Andy, Kevin, where was all the silver and gold that's being purchased in mass quantities and taking delivery on? Well, I mean, we can't just take our little bicycle to the COMEX and pick up in a car the type of deliveries that are being taken.
Well, it's interesting. The Senate said in that interview that they're getting tons of gold from Venezuela, but it came from COMEX, it came from London, it came from the refineries in Zurich, it came from private holdings by large players. It doesn't have to always come off of the exchange, and this is why you get the exchange number saying one thing, but the export number saying another, and that's where the World Gold Council said, no, you're all lying. We see import-export numbers that supersede what came out of the exchange.
What do you think of Bassent's comments that Fort Knox is great, all the gold's there?
Official inventories rarely tell the entire story when global bullion flows increasingly bypass traditional exchanges. What Andy Schectman is highlighting is that import-export data can reveal movements invisible in headline exchange reports. That doesn't automatically validate every theory, but it does expose why investors should compare multiple datasets instead of trusting one narrative. Wealth protection begins with questioning incomplete information. Next, Andy Schectman unravels why official gold inventory claims raise more questions than confidence.
I think it's silly. He had several things that were factually incorrect. What I did take away from it is that you could sit and have a scotch with him and he would hang with you in a conversation like this. He understands gold. He understands fiat. The one thing that he said, I got gold certificates on my wall right there that say payable to the bearer on demand in gold coin instead of in God we trust.
Right.
And he said, the holders of those can go to Fort Knox and get their gold. No, that's not true. That they changed the law years ago on that. So that was incorrect.
I don't think he knew that.
Yeah, well, maybe he didn't.
No.
But anyways, the bottom line is that I think it's silly for them to say it. It's the same thing as,
Not to mention he's not the one that went. It was...
here's the analogy. Your girlfriend, you catch her cheating on you 6 times, and then the phone rings at 3 a.m. She says, oh, it's the wrong number. Let me see your phone. No, trust me.
Right. And, it's crazy because as well as I do, what's the time it would take to audit Fort Knox?
A long time, because it's not just Fort Knox. It would take a long time because I've been involved in these audits at our Brinks facilities, and it's not easy moving big bars and keeping them in order.
And the bars that we hold at Fort Knox, those are bars that potentially have to get drilled.
Yeah, because they're not pure gold.
Correct.
Confidence disappears fastest when verification is replaced with reassurance. Andy Schectman's argument suggests that credible audits matter more than public statements because trust without evidence eventually weakens financial confidence. Markets repeatedly show that transparency becomes valuable precisely when uncertainty rises. Investors protecting long-term purchasing power should pay attention whenever verification is delayed. Next, Andy Schectman reveals why auditing national gold reserves is far more complicated than headlines imply.
But even still, it's not just Fort Knox. It's the U.S. gold is held at Fort Knox, West Point Mint, the Denver Mint, maybe one other place.
There's another one.
I guess it really doesn't matter. But the point of it is that it would take maybe a couple of months, and it would have to be done in a meticulous manner.
With teams of auditors doing that.
Right.
So the fact that he just came out and said, no, we're good. My guys said we're good. I don't know how many people actually bought into the fact that we're good,
Right.
and that it's all there.
Well, remember when Bernanke said the subprime crisis was contained and the next day the markets collapsed? I mean, you can't trust unless you can trust but verify, right?
Yeah, I mean,
and the fact that they haven't verified, going back to the confidence, why gold is performing better than treasuries, because things like that erode confidence. They erode trust. Yeah, you're right. Show me the damn thing and I'll believe you. Well, if it were that important for them, then they would do, I mean, we spend money like it's just stupid. So why not spend the money? And why would you vote down Ron Paul when he tries to pass a bill to do that?
right.
When it seems stupid, it probably is stupid.
Yeah, well, it's, Petunia Banana. Love the name, by the way. Have we achieved retail unobtainium on silver yet? If
No.
not, when? No, we're not there yet. We actually talked about that today in our own meeting, and that certainly I think that the premiums that we're seeing today, Andy brought this up.
Trust is inexpensive until markets demand proof, and then confidence becomes the most valuable asset. This is where Andy Schectman's thesis shifts from price movements toward institutional credibility. Investors often underestimate how quickly confidence can erode when verification is postponed during periods of financial stress. Preserving wealth means evaluating evidence instead of relying solely on official assurances. Next, Andy Schectman exposes why silver premiums could become a stronger signal than spot prices.
I think we were in concert together that we don't think premiums will stay at the numbers that they currently are, both on the buy side and I think even more importantly on the sell side. I think that there will come a time, and we're probably coming to that time sooner than later, where the physical demand will supersede the supply, and that's where you're going to see the premiums change, and it's going to happen very, very quickly. We've seen it before. It happens almost instantaneous, and when it does, it happens often. I mean, we've seen it happen 30 times in a day, premium increases.
Well, I mean, you look at, I was talking to one of the primary distributors and I said to him, there are people who thinking that maybe the U.S. Mint isn't producing silver eagles. And I thought about it for a little bit and I called him and I said, I know the initial allocations you guys are required to take, but after that, is it the reason that the primary distributors aren't taking silver eagles? Is it because the mint isn't making them, or is that you're choking on backdates? And he said it's closer to the second. It's closer to the fact that we are flush with inventory. This is the issue that created the problem with all the low premiums, is that the public sold into this rally, but I would argue the people that sold into it are gone. They're done. The people that have hung on are the strong hands, and those that are accumulating now are strong hands.
Low premiums can create the illusion that physical demand has disappeared, even when market dynamics are quietly changing. Andy Schectman notes, inventory conditions may shift much faster than many investors expect once buying accelerates. Premiums reflect retail supply conditions, not simply silver's quoted price, making them an important secondary indicator. Those watching only futures could miss tightening physical availability. Next, Andy Schectman reveals why today's inventory picture may look completely different after the next demand surge.
So the next time it goes higher, not only do I think there won't be the kind of selling that there was, and hopefully it doesn't happen the first week of January when the ETFs rebalance and the new allocations are coming out, but I think it will be an awakening to a lot of people like, holy shit, I better get something like gold, because to me, the real problem is in the bond market. And you're looking at the Japanese reverse carry trade that is this close from blowing everything up.
Yeah.
As that money is forced home with the higher interest rates that they're paying in Japan, they're going to lose their shirt. And as that happens, just as bullish as it was for equities here over the last 20, 30 years, the unwinding
bearish in the bear market,
chaotic.
bond market, yeah.
Everyone runs out the door.
Yep.
And again, like we said earlier, the market is saying it's not about interest rates, it's more about confidence. That's why you're seeing the 10-year go higher and higher and higher, because no one trusts, right? The Fed is, we've seen rates on the front end come down, right? But the back end keeps going higher. So I don't know. I think that, I think this is a situation where the bond market is the real scary part, because if you see, again, you're seeing higher rates and tighter lending standards. Do you think it's coincidence that the head of credit for both BlackRock and Blackstone resigned last week?
Same time.
Same time.
Markets can ignore bond stress for months before suddenly treating it as the only story that matters. According to Andy Schectman, rising long-term yields may reflect declining confidence rather than expectations for stronger growth. Whether that interpretation proves correct or not, bond markets deserve close attention because they influence borrowing costs across the economy. Portfolio risk often begins long before stock prices react. Next, Andy Schectman exposes why the bond market may be sending a warning equities still ignore.
Yeah.
I mean, aren't these the ones that kept having all the redemption requests in private credit, private equity? It's these things make you go, could it be that there are cracks coming? And if you see a bond market implosion, it's far more dangerous than a stock market.
I was going to say, most people think that they're worried really more so about an equities crash. But reality is the bond market is multiple times larger than the equities market.
And as the bonds go down and interest rates go up, that's confidence, right?
Right.
So how high do interest rates have to go in a system that no one trusts before you say, I'll give up my gold for interest bearing? You get paid back in dollars that are losing their value. So, it's a hard part to realize that de-dollarization is a gradual process, and it's not something that happens today or tomorrow, but it happens over time. And you get to a point where it starts to, the probabilities of that accelerating, it starts out as a walk and then a
I think what you mean is little by little and then all at once.
I do.
And I think that's what you mean.
That's the reason so many people have the ability to dismiss it, because they're not able to see.
Well, they don't see the littles. They only see the all at once. And, the ones that are the smart ones are catching on with the littles and the
littles. The all at once, you tell me that the all at once collapses or booms, that the insiders aren't positioned ahead of that.
Everyone watches stocks, yet history shows confidence often breaks first inside the much larger bond market. What Andy Schectman is highlighting is that gradual deterioration frequently goes unnoticed until markets suddenly reprice risk. Investors waiting for dramatic headlines may miss the quiet signals that institutions monitor months in advance. Protecting capital means respecting slow-moving structural changes before they accelerate. Next, Andy Schectman reveals why institutional positioning often changes long before public narratives catch up.
Shadow Band OG again says 5 largest banks in the world are Chinese. They may have the gold now. Glad to hear someone else knows their history. So clearly we know. All right, let's get a couple more in here. We have OC Stacker saying hello, Kevin and Andrew.
Howdy.
How are you? All right, we already talked about that. We did that. Lazy day. That's just what I heard makes sense. All right, that's good. Going around bands. Sorry, usually Jana does this for us,
but if you can only see her right now.
Oh, you guys have no idea. Okay, so let's just go back to the top real quick because I neglected those. That guy's asked the same question 16 times. What is this? Okay, well, let's put this up here. Wayne Robertson, 7011, says, thanks, Andy and Kevin. Question, Ron's Basement said today that we have way less silver available than people think. Bix might be correct. Thoughts? Well,
I mean, yeah, we probably do, because the market, the COMEX market has lived under the assumption no one would stand for delivery. That's changing. And so they sell the same contract over and over and over again. Same thing in London. So the actual numbers are skewed. If price was reflective of the real supply demand numbers, it would be much higher. And this is what they're trying to change over time in exchanges that are same day settlement, especially in other currencies.
Paper liquidity looks abundant until physical delivery becomes the priority instead of speculation. Andy Schectman's argument suggests that settlement behavior may matter more than contract volume when evaluating silver markets. Futures activity alone cannot fully measure available physical supply, making delivery trends worth monitoring alongside price. Investors relying only on headline quotations risk overlooking tightening conditions beneath the surface. Next, Andy Schectman exposes the reporting gap that may hide true physical demand.
So he's probably right. I think the markets paint a picture. Look, the COMEX market trades roughly 200 times what is available every day. So, how does that happen? What does that mean? That means that there's make-believe contracts that suggest a different price.
Yeah, and I think we're on track for the 6th-year deficit. I think we're about a 46 million ounce deficit is what's projected for this year on what's coming out of the
Can you really
ground.
trust those numbers coming out of the Silver Institute? I'm not quite sure.
I know. Well, certainly I think that there's going to be a deficit. I mean, that we know what the actual numbers are. I don't know. At GDXU X100 said silver pulled out from CME 600,000 ounces today.
Okay, that's my point. It's like, so
Did you pick that up?
No, I didn't see that. And so slowly, I didn't.
No, I'm saying in your car.
No, it's in my trunk.
Okay,
Yeah.
I was going to say, let's go get it. Let's go get
Well,
it.
but that's the thing. Over time, if those that are storing it there that had it delivered slowly start pulling it out like that over time, could it be the U.S. government? Who has the ability? Where is 600,000 ounces going? You know how much that would weigh? A lot.
I want to know where 200 ounces is.
Yeah, I know. That's crazy.
I misplaced 200-ounce bars, and it's driving me nuts.
Not quite sure that's
Is that
possible.
thunder?
Yeah.
That's not good.
A market cannot indefinitely expand paper claims if physical inventories steadily tighten beneath the surface. This is where Andy Schectman's thesis shifts from daily pricing toward the credibility of available supply. While future deficits remain projections, persistent physical withdrawals deserve careful monitoring because they can reshape market sentiment over time. Investors preserving wealth should track inventories, not headlines alone. Next, Andy Schectman reveals why physical movement may become more important than spot price itself.
Let's see here. Chadley72, with solid-state battery coming online next year, using a kilo of fine silver per, and thrifting not being a quality alternative, how could that have an impact on the spot price moving forward?
Just another one of the many
utilities
Yeah.
that silver has. I mean, look, silver's not going anywhere. The use cases are only growing by leaps and bounds. It's just the bottom line. And look, now we have data centers that are going to be put up in space, and those data centers are going to, of course, take silver. And the one problem that data centers have here on Earth is oxidation. We don't have to worry about oxidation in space. So therefore,
Or heat.
right. So therefore, that probably will be using more in outer space than it here is in the on Earth. So there's so many use cases. I think that, again,
This is why they've gone to great lengths to mask the real price.
correct. So,
Because if everyone knew the real value based upon the real supply, silver would go much higher.
which is why when you listen to Bix, he's a believer that we could see the 1-to-1 ratio.
It happened in biblical times.
Yeah, I know.
I mean, look, the truth. Look, please.
That's just unbelievable. The fact that he's sitting on her face and she's not moving.
It's unbelievable.
That's hysterical.
Take a picture.
Yeah,
Of that.
and then maybe we can put it onto our
God,
website.
that she'll kill me if I do that.
She's not wearing lipstick.
It's just unreal. I've never seen anything like this.
Oh, this is a good one. I like this. You ready for this?
Yeah.
So D. Peterson 2630. I think we'll end on this one. This is a good one to end on.
Okay.
D. Peterson 2630 says, if all the silver in the world was distributed evenly, every person would have 2 ounces. That's pretty nuts.
How many people are there? 4 billion?
I don't know, but that's 8 billion ounces.
I don't think there's 8 billion ounces. I think it'd be less than that. Probably more like 1 ounce per person, if that. But
Silver's industrial story keeps expanding, even while most discussions remain fixated on short-term price volatility. Andy Schectman notes the growing technological demand deserves attention alongside traditional investment demand. New applications alone do not guarantee higher prices, but sustained consumption can strengthen long-term supply pressures if production fails to keep pace. Investors should watch usage trends as closely as market sentiment.